It's the Larry Kudlow Show. Free market prosperity starts here. Now, here's Larry Kudlow.
So, welcome back, folks. I'm Larry Kudlow. This is the Larry Kudlow Show. By the way, you can hear this show on the internet. You can live stream us. LarryKudlowShow.com, LarryKudlowShow.com. Hear us all across the country, around the world, throughout the solar system, including the Milky Way. And please, during the week, join us on fabulous Fox Business Network. Name of the show is Kudlow, 4 to 5 p.m. every day, Monday through Friday. And if for some crazy reason you can't get to us at 4, well, don't despair. Just text your favorite 9-year-old, and she will show you how to DVR the show. You'll never miss a thing. Never miss a thing. Stock market. Oh, my gosh. What's going on here? Roller coaster week. Actually, it was another down week. And we had at one point, I think 10 or 11 straight days where the Dow Jones continued to decline. Weird stuff from the Fed. Weird stuff in Washington. Let's talk. David Bahnsen, dear friend, Bahnsen Group, CIO, founder and managing partner, author of the Dividend Cafe.com, and his most recent work, Full Time, Work and the Meaning of Life. Just a wonderful book. And my dear friend Nancy Tengler, CEO and Chief Investment Officer of Laffer Tengler Investments. And Nancy's latest book is The Women's Guide to Successful Investing. So, Nancy Tengler, start with you. I almost said, what should women do? But, that would be wrong. I mean, I'll get tremendous emails on that one. What should people...
Not from me.
What should people do? I mean, here's the fact. By the way, just to have some fun here. On Wednesday, so Jerome Powell gets up there and says, inflation is worse than we thought. It's going to be longer, so I'm cutting interest rates. And The market falls 1,100 points, which I just kind of read as a big vote of no confidence in Jay Powell, period, full stop. I mean, let's just start with that. What'd you make of that story?
Yeah, I mean, and it's about time. I think I wrote a piece in 2023 called "It's Time to Replace the Fed with Chat GPT," because at least AI learns from its mistakes. And I think this Fed has been so consistently wrong and so not humble about being wrong. And so consequently, we hear this phrase and the reporters repeat it when they ask their questions, the data dependent phrase. But it seems to me the only data they're dependent on is the Fed funds futures, because the actions, as you point out, make no sense. You don't lower rates if you think that inflation is sticky, and it is, even though we got a decent core PCE later in the week. But core X food and energy, that's not how Americans live. And so, they actually have to buy food and energy. So I think it's time for an overhaul, for a return to common sense and a mute button, because all of the Fed governors are out talking. That creates expectations in the market, and then they don't want to disappoint the market, which is exactly the wrong way to manage Fed policy. So I don't even listen anymore. I mean, I did listen, but I'm amazed at the gobbledygook and the lack of coherence and the flip-flops within the same press conference. So I think you shut that aside and you pay attention to what's going on in Washington, but most importantly, what's going on in corporate earnings. And that's going to be a pretty decent story. Yeah. Profits
have sustained this market for quite some time. I mean, profits have sustained this market for, 7, 8 years, maybe longer. I personally think Jay Powell should resign. I think that we have a new president, new administration, new Treasury Secretary, et cetera. He should resign. Let Trump put Kevin Warsh in there. That's what I think the game plan is going to be. Warsh is a Federal Reserve veteran. He was a governor for many years, including during the financial crisis. And he's a very, very smart guy. And maybe most importantly, he's a logical guy. I mean, here's the thing. So David Bahnsen was on set that crucial day, and I had this long riff And I knew what was coming. He agreed with me about delaying the tax cuts. He agreed with me about how silly the Fed is being. And then, of course, I knew this was coming. He said the only thing I think he called the riff brilliant, except for the fact that I called for passive investing. I love that. And he just jumped right on it. So, David Bahnsen.
We all hate that.
I know. I know. Some of my best friends are active and you're all very good at it. I didn't say, I said I respect people who disagree with me. But, Bahnsen, I want to ask you something important, because not only did stocks revolt from Jay Powell, but bonds did too. Ed Yardeni's bond vigilantes have run the 10-year back to, I got 453 on Friday, whatever. Bonds, I think, got as low when they had the jumbo rate cut. Running into that, it was as low as about 350 or something, and then they're up. So it's up almost 100 points, and that has affected mortgage rates also. So the bond market is very unhappy with the Fed also, David Bahnsen.
Well, so Larry, first I just want to say that I'd be far more open to the passive investing idea if you would just call it NVIDIA, which apparently is all that it really is. It's just one large over-concentrated play. But, the weightings in the passive world have changed a lot over the years. But I see your point. Look, Larry, the thing with the Fed, I agree with 9 out of 10 things that Nancy just said. I do want to point out that I don't believe it's Jay Powell's fault that we have asked the Fed to please provide us full employment and price stability. That is not the job of 12 PhDs. I agree that the Fed is arrogant, but I think it is institutionally arrogant. I agree that the mandate is crazy and that there are mixed signals. I don't expect the Fed to say the truth here, which is that they do believe that there's some sticky prices staying higher, and yet actually the only way to get those prices lower is to cut rates because housing is frozen and they can't get housing to reset until rates come down. That they created by their own extreme policy on the low side and then extreme on the high side. They created the stickiness in housing. But Larry, if we want to talk about incoherence, I think Nancy will agree with me. What's more incoherent than saying we're cutting rates and we're doing quantitative tightening?
Right.
They have one hand tightening and one hand loosening.
Right.
All if they want easier policy, then stop reducing the balance sheet. Now they need to reduce the balance sheet because they let it go too high. So this is where the 9 out of 10 comes in my agreement with you and Nancy. All of this is a byproduct of the Fed dealing with imperfect choices around past mistakes. That's all monetary policy has been my entire life. Is the central banks cleaning up past mistakes that they've made.
Yeah.
And I think I am a Hayekian to the core. That no one has the knowledge to do this. No central planner can take on the stewardship of the full economy. I know who can set interest rates right. It's called borrowers and lenders, buyers and sellers. That is the optimal monetary policy. We brought in central planning, and I'm a little bit less mad at Jay Powell for the way he does it than I am for the fact that we have asked a central bank to do something that can't be done.
Well, I don't know, maybe so. But the point is, as I quoted Robert Mundell that day, who was a Nobel Prize winner and brilliant man, the late Robert Mundell, who said, if you want to curb inflation, that's a monetary issue. You need a strong dollar and minimal money growth. If you want to promote economic growth in the economy, promote better growth from the supply side, that's a fiscal issue, and you should be lowering tax rates. It was very simple, and it was kind of like tight money and tax cuts. And so let's take the housing thing. All right, there are regulatory issues with housing. Some are federal, but most are state and local regulatory issues. But insofar as mortgage rates go, and insofar as interest rates in general, David, the best way to get rates down is to curb their high-powered balance sheet. Get inflation expectations down. He doesn't talk that language. He does not talk that language because he doesn't understand it. And he's a nice guy, by the way. I'm not attacking him personally. I know Jay quite well. Lord knows we had so many lunches when I was in the government for 3 years. But The balance sheet is still $7 trillion.
Yeah.
Okay. 15 years ago, it was less than $1 trillion.
Yeah.
They need to get it down. And it isn't, people say if the Fed lets bonds run off, mortgage-backed bonds, treasury bonds, that will cause rates to go up. I completely disagree. That will bring rates down. The Fed should talk about how they'll be withdrawing excess money. They don't need it. And then lower inflation expectations will bring the mortgage rate here. I have Freddie Mac mortgage rate 7.29. Okay, that's crazy. That too is up 100 basis points since the jumbo rate cut. That's what they need to do. And they do that, we'll all live happily ever after. I mean, that's all they need to do. And I agree with you about the central planning, of course. But I'm just saying, tighten up your money supply, tighten up your balance sheet. That will less money, less demand, and let the supply side policies of tax cuts and deregulation promote economic growth. You'll have more goods and services chasing less money, and there you have it. Prosperity.
This goes back to the perfect speech you gave the other day on air. I agree with you 100%. The look, but again, the balance sheet was $5 trillion when Jay got there. Okay, so this is what I mean by we're constantly having to clean up from the past generation's mistakes. Bernanke wrote a book doing a victory lap as to how well QE went to get out of financial crisis, but the balance sheet was still at the peak.
Yep.
It's like celebrating, doing your victory lap before the race is over.
Yep.
Jay did get $2 trillion off the balance sheet in the last couple of years. I didn't think he'd be able to get that much off without more disruption in financial markets. You're exactly right. 3 out of 3 times when they began reducing the balance sheet, rates went down, not up.
Yep.
So that will happen again. But ultimately, the Fed funds rate cannot be at 4.5 and get mortgage rates back down to something, let's call it halfway between the lows and the highs we've seen. And that's the issue. You're right. But, this also connects what Nancy said earlier. I think she's right that core inflation versus headline is not helpful to real people. But I do think it's an important distinction for the Fed, because I don't believe the interest rate has anything to do with the price of money, price of oil whatsoever.
Well, the thing is.
They can't control state and local regulations. They can't control oil. The money supply and supply side issues. Milton Friedman meets Friedrich Hayek, meets Larry Kudlow and Art Laffer. That's the key for...
and stick Mundell in there, because he was so important. And he was at Chicago with Milton, of course. I knew him very well, the late Mundell. You're right. The Fed funds rate is the most overhyped thing in all policy. It's just overhyped. It's just a big nothing burger. And you've got 400 PhDs who all give their political donations to Democrats who have completely rejiggered what monetary policy should look like. Anyway, the stock market's still not in bad shape. I mean, what do we got? 42,000 Dow, almost a 43,000 Dow, and a almost 6,000 S&P 500. So that ain't bad. Let me take a quick break, and we'll come back with some recommendations. By the way, Nancy Tengler is always right. I've learned that down through the years. There's no question about that. Nancy Tengler, CEO and Chief Investment Officer of Laffer Tengler, and Dave Bahnsen, founder and managing director of the Bahnsen Group. I'm Kudlow. Be right back.
This is the Larry Kudlow Show. Now, back to the Larry Kudlow Show.
We're talking stocks with two of the best, Nancy Tengler, CEO and CIO of Laffer Tengler Investments, Dave Bahnsen, the Bahnsen Group, CIO, founder, and managing partner. Dave's book, Full-Time Work and the Meaning of Life. I love to push it because it's an important book. Okay, Nancy Tengler, I have been and am still worried about delaying the tax cuts as a negative influence on stocks, because the Dow went down 9 straight days before the goofy Fed thing. I know that profits are very decent, so profits are the mother's milk of stocks. How do you see this now? How would you recommend an investment strategy? We just got a couple minutes left because we went long in the first segment.
Okay. Well, I agree with you. I'm worried about that too, the tax cuts. But I just wrote a piece recently called Youth and Inexperience, and I used Ronald Reagan's quote. that he wouldn't make age for political purposes. He wouldn't exploit Mondale's age because, people are asking me that question. And so the average age of a portfolio manager is 40 to 45 years, and they mostly work at hedge funds. And that's what's driving volatility. But if you take a step back and you look at what's going to drive the economy, it is productivity. And I've been harping on this for 2 years now. We are in a productivity-driven growth environment, just like the 90s. And in that period, we coexisted with higher interest rates and higher inflation. Fed funds rate came into the decade at 8, went out at 5 in the 90s. And so we like names that are going to benefit from that. Broadcom is a name we were buying in 2018. It's up 1,200%. Can it go up more? Yes, it can. And the reason is because they're in the sweet spot of AI on not just the chip side, but on the software side. ServiceNow is another one. The CEO came out last week and said he expects AI spending to be $20 trillion between now and the end of the decade.
Wow.
That stock's up 300%. And then Amazon, since the IPO, that stock's up 275,000%. And so when was it too late? In many of these names, it's never too late. So those are our kind of stocks.
And Jeff Bezos is a Trump convert.
Yes,
David Bahnsen, I got about 80 seconds. What do you make of it?
Well, look, I agree with Nancy on Broadcom. It's funny. I always think that she and I have so much in common, and we both bought Broadcom in 2018. So great minds think alike. It's been amazing. And I just want to add, it's the dividend growth of Broadcom. Our yield, cash on cash, is 30% per year from what we originally paid for it, even though now it's only a current yield of 1%. With this AI stuff, if you want to de-risk some of the names, because there's going to be a lot that succeed and a lot that fail, but boy, companies with cash flow that are returning some of it to you, those are a lot safer ways to play speculative aspects of the market.
It's energy companies. We were talking to Steve Koonin before in the prior segment, the brilliant physicist on climate. We're going to need a lot of electricity, David. A lot.
Yeah.
So how about some of these big energy companies that pay dividends?
Well, I think it's a great play, but you're going to need a few things. You're going to need pipelines. You're going to move natural gas to the places they're going to power the electricity, because you're not getting electricity without natty gas. And that is the biggest aspect. Biden was a good president for Chevron and Exxon because he didn't let anybody else produce, and so they got all the money for production.
All right.
But Trump is a great natural gas president.
All right.
People will see.
Nancy Tengler, thank you. David Bahnsen, thank you. Folks, quick break. We're going to do some money and politics with David Asman and John McLaughlin. I'm Kudlow. Stick around. Much more.